My name is David Nazar and I'm the managing partner of Ironshield Capital. So we're a hedge fund, we're based in London, and our area of specialism is investing in low-grade credit. So that's anywhere from normal high-yield investments, bonds on an event-driven basis, right the way through to distressed credit, which is obviously at the very bottom end of the credit rating spectrum. I started Ironshield, which is in 2007, so that's 16 and a half years. And in total, I've been doing that for 2 decades. I worked at investment banks prior to that in the same strategy. So that's our specialism. We have a team of dedicated people who help execute that strategy with me. Our goal is to deliver very good risk-adjusted returns to investors. Because we are a analysis-based strategy rather than a trading-based strategy, I think a key component for being successful at this strategy is being able to focus and not deviate from that focus until you get to final answers and you've peeled back many, many different layers of analysis, story, fact, until you understand the key drivers of what is driving a potential risk-reward, a potential trade. And I think that a key mistake that people can make in our space is to be satisfied with answers which on the surface appear to make sense, but they haven't been questioned enough. The thesis hasn't been pulled to pieces. There hasn't been an interaction, between different members of the team to try and understand if that credit thesis actually works or not, or whether there's a deeper story. And so that's what I think the key personality characteristic is for being successful in our business. In terms of the team and how they're empowered to do that, we're a team of equals. Everybody has a place to question the work that we do. We discuss credits as a team. Obviously, individual people will do the individual credit work, but then that's thrown out to the wider group to discuss, and as I said, to analyse and to pull to pieces and see if it makes sense and see if that thesis itself is stress tested. And I think people in the team having that direct control on shaping the portfolio is a very attractive experience for them. And I think you don't get that with a lot of investment strategies, which maybe are more hierarchical in terms of decision making. And that's also the strongest way of making decisions. So obviously we can create the best return stream for our investors using that process. To me, it's every credit, however difficult it is to understand, however maybe beaten up it is because it's distressed, has a price. And with a lot of the credits we're looking at, the market struggles to find that price, and we can find that price. And that is really interesting for me to be able to do that, because you come in with a sort of shapeless mass of sometimes contradictory information and incomplete information set, and actually navigating a way through that to come up with a rational, probability-based answer in terms of what a piece of credit is worth is a really interesting process. I think the opportunity is increased in a multi-dimensional way. So firstly, there's more credits that the market is going to have difficulty pricing because they're either stressed or distressed or riskier than the market perceived before. So there's numerically more, but also there's more dispersion because it's more difficult for the market, which is no longer in a steady state, to actually price each individual credit. So it's more numerous, more dispersion within each credit. And the other thing I'll mention is that when I started out, the European high yield market was about 100 billion in size. And now it's about 7 times that. And the leveraged loan market is probably something similar. So you've had an incredibly aggressive expansion of leveraged credit over the last decade. And the reason you've had that is because rates are so low, many more companies could afford that leveraged cat stack because the risk-free rate was basically zero. So you've got a very significant change in the cost of debt coming at a time when you've got a record ever level of risky credit, of sub-investment grade credit. That's what makes our space so interesting. The outlook is extremely interesting for our strategy, and I think that's a medium to long-term outlook. And the reason is because if you look at the last 3 decades, 3 to 4 decades, what's happened to risk-free rates, i.e. government bond yields, is that they've declined very steadily. So if you look at the German Bund 3 decades ago, that was 9%, and it went down to obviously 0 and below 0. Now what's happened is you've seen a sharp reversal of both short-term and long-term risk-free rates, government bond yields. So if you looked at that on a chart, you would see that that's quite a startling change to the regime that's happened over the previous 3 decades that ended in December 2021. So with risk-free rates higher, it makes debt more expensive for every company and every person. And when you think about companies, if you're investment grade, now you don't want your debt to be more expensive, but generally speaking, you've got low leverage and you can easily afford the interest. But when you come to sub-investment grade, where we specialize, and particularly stressed and distressed, often the new interest rates are unaffordable for those companies. And to make them affordable, there has to be a restructuring of the balance sheet. And a restructuring of the balance sheet is a distressed situation, and that's what we specialize in. So we look at risk in 2 ways. Firstly, as an absolute loss that we're willing to risk on a particular credit. So obviously we model different scenarios for different credits, and we'll size a position such that it won't trigger certain parameters in terms of a maximum loss. That's one way. The other way is more statistically when we model them in terms of how they fit in our portfolio, and we're calculating variance and standard deviation on different scenarios as well, allows us to control risk in individual credits and the overall portfolio. And I think the results of that, are our Sortino ratio, which I mentioned before, which is obviously extremely high at 2.4. And the other thing is just if we look at the number of credits we've invested in, which is probably around 300 since we started, I think we've lost more than 2% on a handful of those. So maybe 4 or 5. So, we have a very, very good track record of controlling downside risk. And when I think about the investment process, the split of time between looking at upsides and looking at downsides is probably about 10% to 90%. So generally speaking, the upside is relatively clearly defined, and we spend our time working out all the different ways that we may not get that upside. And obviously that's part of the process that we go through to understand whether a credit at a particular price is attractive or not.
And also, why do investors invest with you? What benefits do you offer?
I think investors invest with us primarily because they've decided they want exposure to our market. And then once they've decided that, they're looking at probably a track record, which, as I mentioned, obviously is an IRR and a Sortino ratio or a Sharpe ratio. And then I think we obviously look very good in that comparison. And then I think what they're looking for is someone with a repeatable process, which again we have and we can demonstrate. And then I think the last thing, and probably the most important thing, is trust. So investors want to trust that the people in our business are going to continue to make well-balanced, reasonable decisions in the pursuit of creating that return stream that they're looking for. And that's why investors ultimately will pull the trigger and allocate to us.